Well, this week we're reviewing the Absa Select Equity Fund. It's managed by Roland Rousseau. The formation date of this fund was February 2004. Fund size 1.4 billion rand, so sizable there. Looking at that benchmark, it's the JSE All Share Index, and the total expense ratio comes in at 1.53%. I suppose, Cobie, what stands out here is that they said any one time the exposure to shares, that is equities, of course, will exceed at least 75%.
Yeah, I mean, this is a classic long-only equity fund. And by the way, the classification that we've utilized here, we've looked at managers that have been listed here over the long term in this specific category. So any new managers that have started getting listed into this category and potentially are calling themselves general equity funds, we've excluded those. These are kind of guys that have been in this space for a very long period of time. If you want to see what those performance numbers look like for Roland Rousseau's fund, just have a look at your screen. And you'll see there's a table with the returns, and quite frankly, that reads like poetry. Look over the last 5 years. There's a total return there of 10.7 versus a benchmark return of 6.4%. Over the last 3 years, 18.9 versus 18.2. And just to kind of give you an indication of maybe just a little bit about the profile about this fund, you can see the blue lines there, the blue bars or the blue shaded areas. That's the fund's return, a relative return to the benchmark. You see great outperformance relative to the benchmark in both that period there and in a more later period over here. And here you can see the return of the all-share index on the rolling 12-month basis. Underperformance, obviously, that's a negative space that you saw with the subprime crisis, the recovery, and the subsequent returns that we've seen for the market at the moment.
Colin, what stands out for you with this fund? I mean, why has Roland Rousseau, who's now the current manager, been able to get it so right?
One thing that stands out for me is during the global financial crisis, Errol basically outperformed the index by quite some margin, and that's always a sign of a good stock picker, and I think a solid investment professional that Errol is that during the difficult market environments they're able to add value and to limit losses.
This puts the case forward for active management, Shirley. Roland?
You know, Errol. I mean, before Roland gets in, I mean, Errol
before Roland gets in, Shane, let Roland have a chance, Cobie.
Errol's a stalwart in the industry. I mean, he's with Absa at the moment. Before this, he was with Stand-Up, and before that, he literally was with Liberty Asset Management for a very long period of time. So, I mean, he's gone through the mill, the asset management mill, and I mean, what you see is a very fine investment professional today.
Yeah. He's getting it right. Roland, time for your 2 cents worth.
I think Errol's probably the closest we have to a Warren Buffett in South Africa, a very persistent and consistent kind of investor. He also has a very interesting ability to have a very defensive kind of position in his fund, and that's why you see such outperformance during the crisis. I mean, we're looking at 20% outperformance relative to the market during the subprime crisis. And I looked at this fund in a bit more depth, and what we're finding is a very high exposure to industrial, in the industrial sector, and within that the overweights he's taken relative to his peer group is in consumer cyclicals and an underweight in resources relative to his peers. So he's clearly putting his money in terms of a local kind of consumer boom, but also a very defensive positioning in all his other stocks, which are your typical kind of Anglos and Billitons, which are conservative mining stocks rather than the more geared mining companies.
When might this fund start not delivering as sound returns as we've seen?
That's a very good question, because this fund is positioned for, I would say, bad times, and we're currently in bad times, so it's a good fund right now. But what will tend to happen, and currently the manager's sitting on 10% in cash, so if the market suddenly had a very sharp recovery, this manager is at risk of underperforming, because they have to get into that market very quickly. Now with cash, that's not such a bad thing, but if you because you can implement that cash a lot quicker than having to sell first and then buy other shares. But any kind of sharp recovery, this fund...
It doesn't look like we're going to have that anytime soon, right, Colin? No. And your thoughts on that? I mean, all the uncertainty, you know, negative news flow continues, and Europe continues to kind of dog the markets down.
Look, short-term market predictions is just a guessing game, and it's hard to say. The market is fluctuating between, you know, your risk on and risk off trade, and you know, who knows how that's going to develop over the next few months. So,
But I suppose you just assume that someone like Errol, who's been around for a long time, would then obviously see that and start, adjusting the portfolio.
Well, again, like Roland says, defensively placed relative to where the market is going. Sharp recovery in the market, it might be a false run. So you might actually sit in a situation where the market quickly runs up and starts falling back again. And we're seeing a lot of that just on the intraday. You see a little bit of positive economic news, market runs by 200 points. And then all of a sudden it turns negative again, market's down by 200 points.
How tough has that made it for active managers?
I think it makes it hugely tough. As a matter of fact, if you look at active managers as a group at the moment, they're actually battling because of all this volatility.
That's the cross correlations.
And then you've
Risk
got valuations
means
just all
that
over
everything goes up and down together. So stock picking really doesn't work that well, even if you've got skill.
Yeah, but I think that if I just look at it and I just kind of think about it logically, if you've got this amount of volatility and you've got this divergence in valuation, at some point somebody goes and says, well, you know what, why don't I apply some fundamentals here, and you actually do it, and then you see the benefit, but you don't see the benefit now. You potentially see the benefit in 2 and 3 and 4 years time from now. The point is though, is that in 4 years time we might all look back in the market and say, oh, we should have bought some of these stocks. Why didn't we buy when we could? We should have got in.
Is he buying in the right spaces, just from your view, Colin? Do you like the sector weightings at this point?
I actually haven't looked at the sector weightings, but what I have picked up from the brief look that I had at the fund is that it's been a consistent outperformer. And going back to your original question is, even if the fund does underperform for periods of time, it doesn't necessarily make it a bad fund. These cycles of outperformance and underperformance are part and parcel of active management. But what I can say is, looking back over the last 5 to 6 years, the fund does have an unusually good track record of outperformance consistency, which is really the holy grail of active management.
And this is the point. And that's exactly, what is it that you're trying to achieve as an investor? If you want to get and approximate the market return, then the best thing to do is be passive. If you're not wanting to do that and you're happy to throw in your lot with an active manager, find somebody you are philosophically aligned to.
Yep, we've got
fantastic.
Let's look at that sector allocation, because we have got that graph, and just give you an idea of where the sector weightings stand at this point. Basic materials, the largest chunk, followed by consumer services, financials, and there we go, Roland, as you were saying, very heavily skewed towards industrials.
Yes, we must just be careful that basic materials looks like it is a big weighting, but there are many sub-industrial categories that you've got to add up here, which will swamp that resource allocation. So it's very much an industrially focused.
That's pretty cheap, this fund. TR, 1.53%.
Yeah, I think it's reasonably priced. Reasonably priced for fund size, reasonably priced for what you get, and then you're getting some fairly decent active asset management behind you. Okay,
so there's nothing you don't like about this fund. Is that what I'm reading right now?
Well, ensure that it's aligned to your objectives.
Okay,
from an investment perspective.
I think the TR at 1.53, if it got any higher than that, it would kind of start to get a little bit expensive in my mind.
Okay.
So I think TRs, 1.5% for a general equity fund is just about at the limit that I would accept.